It seems undeniable to me, though, that you must be thinking about the impact of higher rates on the kinds of stocks that have been tried and true winners for you all throughout, whether it's the Signature Fund, the FinTech Innovation Fund, and even other areas of the ETFs that you have. Are you worried that as rates go up, those stocks could come down?
Well, I do believe if rates were to take a sharp turn up, that we would see a valuation reset, and our portfolios would be prime candidates for that valuation reset. Of course, I agree with you, Scott. There will be a valuation reset. There will be fear, I'm sure, and we will use it to our benefit, concentrating our portfolio to our highest conviction names.
Hey, good people, and welcome to the PlantStock channel. If we haven't met yet, my name is Jesse. Today, I thought we would do a different video considering what's happening in the market right now, because I do understand that there are a lot of investors out there who are both new to the investment scene or who are just nervous about what's going on. And that's understandable, right? So I thought to be able to get a sense what you could do about it, we would talk about what the investment queen, Cathie Wood from Ark Investment, would do. Cathie Wood has over 40 years of investment experience, and she does run one of the most successful ETFs out there, as I'm sure many of you have heard about. So I find her strategies very interesting. This is a two-part series, and in part two, we're going to talk about what this means for those of you who have planned stocks, and if you should be worried regarding some of them. Are some of them more risky than others? And what should you do about that? And that's what we're going to talk about in part two. So stay tuned for the next video after this. And as always, folks, I would truly appreciate an early thumbs up, since it will help spread the video to other people out there. And if you want to keep getting more information regarding plant-based companies or investment philosophies, also make sure to subscribe, right? And don't forget that bell button. Thank you, guys. I truly appreciate you. As we know, and that we have talked about on this channel, one of the larger reasons to why we see even more volatility in the stock market right now is due to the worry about the Fed raising the interest rates. Just to get some quick background, considering what happened during the pandemic, the Fed printed more and more money to try to combat the issues that has faced millions of people's livelihood by lowering interest rates. And this has led to a rally in the stock market over the last year, bearing in mind that lending money has been cheaper than ever. And even though I don't believe that we will see any raising of the interest rates right now, not significantly anyhow, considering that no one will gain from that, since the huge unemployment needs to be combated first. As I've stated several times, if people don't have jobs, right, they can't pay off any loans to begin with. They can't consume more, which is something that the Federal Reserve wants to remedy. But still, the raising of the interest rates will more than likely happen at some point. And that is why it would be wise to have some ideas on how to prepare for this situation. So to begin with, what does Cathie Wood think? Will we see a market crash?
It seems undeniable to me, though, that you must be thinking about the impact of higher rates on the kinds of stocks that have been tried and true winners for you all throughout, whether it's the Signature Fund, the FinTech Innovation Fund, and even other areas of the ETFs that you have. Are you worried that as rates go up, those stocks could come down?
Well, I do believe if rates were to take a sharp turn up, that we would see a valuation reset, and our portfolios would be prime candidates for that valuation reset, of course. Now, one of the things that I've found interesting over the last really 20 years is that the S&P's PE ratio tends to peak out in the 20 to 25 times range of the forward earnings. And I think the reason for that is most portfolio managers and maybe quantitative researchers are looking at normalized nominal GDP growth in the 4 to 5% range, which is where long-term interest rates should be normalized. We actually think normalized GDP growth is probably closer to 3. Now, if you think, and that's where long-term interest rates should stabilize. If you think of 20 to 25 times, that's 1 over 4 to 5% growth. So it's the inverse of the growth rate, the nominal GDP growth. And that's where it seemed to be peaking out. We think there's actually longer term. I agree with you, Scott. There will be a valuation reset. There will be fear, I'm sure, and we will use it to our benefit, concentrating our portfolio to our highest conviction names. But I think longer term, especially given the powerful growth trajectories that the 5 innovation platforms around which we revolve all of our research, that those trajectories are so powerful that these multiples, that these companies are going to grow into their multiples a lot faster than most investors are now expecting. And so that's a source of confidence for us.
She talks about her innovation stocks, that yes, they will more than likely take a beating, but when the correction has landed, these innovative companies and stocks will come back, and a lot faster overall future growth than most people are expecting, meaning that they won't only regain their former glory, their former price, they will fly past it. So while a stock market crash is nerve-wracking for some people, in my opinion, there is no need to be worried. Instead, it is a perfect opportunity to invest more money into those stocks that you believe in the most. And as we know, with plant-based stocks, these are disruptive growth stocks, and they will be more volatile than any other stock, and could possibly take a harder beating than other conventional stocks, like value stocks. But like Cathie mentions, these disruptive stocks, innovation stocks, will get a massive growth path when the correction has ended. So should you perhaps sell off your positions now and buy in when they might have fallen down further? Well, as many of you know by now, I don't believe in timing the market. So what options do you have? Cathie Wood has a unique strategy that she and her team exercises.
So my question plays off what Scott just asked you. Do you take into account, or do you have any type of forecast in terms of rates and adjust the portfolio to that forecast? Or do you keep cash there? And ETFs are kind of interesting in terms of the level of cash you're allowed to keep or not keep. So how do you do it? So rates right now, they're moving up. Do you say, okay, we may be in a little trouble here with this valuation reset. They're going to jump up another whatever up to, maybe 2%. Do you get in front of it, or do you just take it as it comes?
No, we use it actually. And so what we've been doing for the last 6 months is expanding the number of names in our portfolio. And we do that as a bull market extends, because in some ways it's a tax efficient strategy. What we will do during a correction, especially a severe correction like the coronavirus crisis presented, we will sell names in which are creating losses now, because again, we've bought them, we've diversified and bought them more recently. Sell those names creating losses to buy our highest conviction names. Some of the names we've been moving into, you'll notice, are names like some of the bigger biotech names, Regeneron, Novartis, Takeda. And what we will do during, and we think of them as cash-like, but there's also a reason, an investment reason we are moving into them. Ironically, we think they're deep value names because these companies, the ones we are choosing, they are able to use the convergence of technologies that is taking place today in the genomic revolution. So DNA sequencing, artificial intelligence, once again, and gene therapies, new technologies, new ways of doing things. They are investing aggressively now. They have to, because they've lost a lot of their pipelines, or will soon do so. And we think the returns on investment in the biotech space, and I'm talking big biotechs, if they're doing this correctly, could move from the high single digits today back into the golden age of healthcare. So in the 80s, we saw 20 to 30%. So we're using them as cash-like instruments in some way, because we will move back into our pure play names if we get into a severe correction. but we also see the investment merit in these names. They're just not pure play names.
Well, as we understood from the interview, she would also buy stocks in undervalued companies, but companies that she believes will do okay. Why undervalued? Well, because likely they won't go down much more, bearing in mind that they are already undervalued and will hopefully not get that affected by a potential crash. Thereafter, when the stock market has corrected itself, you sell off these positions and start buying more of your high conviction stocks, the stocks that you have believed in all along and hopefully didn't sell out of during these corrections. Chances are that you will get these incredible growth stocks at a huge discount. Be it Tesla, Square, Beyond Meat, Tattooed Chef, and the very good butchers. The list goes on. She also talks about selling your stocks that you're not as sure of, and then employing this strategy. And I do know that several of you probably have many different stocks in your portfolio. And if that is the case, I really think that this strategy of hers is really interesting and effective. I would say that if you have more than 10 stocks, and maybe many of you have way more than that, then employing this method might be for you. I mean, you can't feel 100% convinced about 20 to 40 stocks, right? I mean, how can you keep up with that many companies? So selling off those companies that you don't have the same conviction on, and maybe placing that money for now in these types of so-called deep value stock companies that won't be affected by a potential stock market crash and that might actually grow during this period or even when the market has ended its correction. Some of you might think, well, why not just sell off those stocks and have some cash at hand, and when things have cooled down, just start buying into those conviction stocks. That might be okay, but we don't know how long this market correction might take, right? Some corrections take several years before the market levels out and eventually starts to grow again. We just don't know, and there's no way of predicting this. I have heard from secondhand sources that Cathie Wood believes that if a real crash happens, it won't last for many months, bearing in mind all the innovation companies that are getting stronger and stronger and will be able to handle this crisis relatively quickly. But again, we can't be certain of that. And as we know, just keeping money in the bank, especially for long periods of time, is not a smart move from a value perspective, bearing in mind that money loses its value. Some of you might have other ideas how to hedge your money during a crisis. And then please feel free to let us know down in the comments. It's really fun to see some of your ideas. So what about those of us who don't believe in keeping too many stocks, right? Like me, for instance. I believe, as we've talked about in former videos, that it's better to just have a few stocks, be it 3, 4, 5, 6 stocks or something like that, and being really convicted by them, right? That you truly believe in them. Because as we know, how can you know everything there is to know about a company if you have 20, 40, 50 stocks, right? How can you know what's going on? How could you understand their visions, right? Their economics, their financials? How do you understand the management team, the CEO, and so on? So for me, it is better to just keep a few stocks. Like Warren Buffett says, it's enough to actually find 3 really great companies and you'll be a wealthy person with time. You just keep investing in those companies as time goes by. And then what about the different plant-based companies out there, right? Like Beyond Meat, the Tattooed Chef company, the very good butchers, Else Nutrition, Eat Beyond, and so on. What about those companies? Are some of them more vulnerable during a stock crash? And what should you do about that? Well, that's what I'm going to talk about in part 2 of this series. So guys, stay tuned. Guys, I truly hope you found some value in today's video. And if you did, make sure to smash that like button. And if you want to keep getting information regarding plant-based companies and stocks, and also some investment philosophies, make sure to subscribe and don't forget to press that bell button. And as we have talked about on many occasions, I am not a financial advisor. These are just my own thoughts and opinions. Always do your own due diligence and invest safe. Hope to see you guys soon. Thank you for today. Peace out.